Hey everybody, welcome to the Presidio Perspective Podcast. I'm Dustin, TenBreock. Here with me today is Jeff Anderson, CFA, Chartered Financial Analyst. Yeah. You're certified as well. And Chief Investment Officer at Presidio Capital Management. So glad to be back here, Season 3, after a long hiatus. Got a lot to talk to you about today. We're going to be reviewing inflation, interest rates, and risky business. As always, I just want to make sure to mention that this show is educational, informative, hopefully entertaining, but nothing that we say here on the show should be constituted as advice. So just make sure that you have an agreement with a financial or tax professional, hopefully as a fiduciary, to get said advice. And go ahead and do that before making any tax or investment decisions. So, Jeff, good to be with you today, man.
Good to be here.
Thanks so, inflation. I mean, we've been harping on this for a long time, something that we talk about in our coursework, something we talk about with our clients, and of course when it comes to portfolio decisions. But all of a sudden, other people are talking about it too. It's kind of like the buzzword out there, inflation. We've had some new readings pretty recently.
Yeah, we have. I think the last podcast you guys had was, last year?
Yeah, earlier right before the summer, yeah.
And I remember inflation being the topic of the day when I was watching you, and I believe it was Luke. And here we are a year later from the pandemic, a year and a half later, and we're still talking about inflation.
Yeah, well, we got the highest reading that we've had in 31 years, 6.2%. So it hasn't been since 1990. Actually, November of 90 is exactly 31 years ago. It's the last time we had an inflation rate like that. So 6.2%. Essentially, all of the money that we have today has lost 6.2% over the last 12 months.
Crazy.
It is crazy, right? And something that we've talked about of why you need to be invested and have a plan, and it's just that silent killer, something that's working against us constantly. But I mean, and that's the consumer price index, right? And so there might be some of us that don't fully believe that that is the true inflation rate, right? Is that it's all just CPI, because of course that is a government-controlled index basket of goods and services. And they got to kind of pick and choose what is in that basket from year to year, and it kind of changes around. But 6.2%. So those of you receiving Social Security checks, you're going to get a nice little pay raise in January. You're going to see a big bump in your check. I think it's 5.9 was the reading for Social Security checks, so that's on its way. But yeah, I mean, let's just talk about some other inflation numbers, because the 6.2%, again, that's the CPI. But I mean, if you look at some of the other things, like, you know, inflation, we do pretty well in times of inflation when we look at our asset prices. Right? So what are the things that go up? Real estate, stocks, etc. You know, we see that inflation of these rising prices of things, and so the things that we own. I mean, have you been out in the used car market recently?
Yeah, it's gone crazy.
It's nuts, right?
There are cars selling, 1-2-year-old cars selling for more than the new model on the lot.
Right, exactly. I think new cars have surged, right, 6%. Around that CPI number, have gone up about 6% over the last 12 months. Used cars, let me just read it here, 21% over the past year. You know, so actually we're sitting down. If you're out there with a lease, right, if you have leased a car, typically at the end of that lease you have some option to buy the car out, which is essentially a lease, is you're kind of paying for half the car, and then you have the option to buy the other half or turn in the keys. A lot of people are looking at the deal that they have made to buy the rest of the car, and it's actually worth a lot more. So before you turn in those keys on those leases, make sure you get a Kelley Blue Book value of what the used car is worth, and then what you can buy it for. You might have a little arbitrage. I bet you these dealerships want to make a deal because they don't have a lot of supply.
And I'll bet you the dealerships are calling you up, asking you to turn it in early.
I haven't gotten my call yet, but that'd be great. I would love that, you know, save me the hassle. Real estate shot up, right? So, and this year we're looking at California, so this is based on the California Association of Realtors.
Right.
For 2021, housing in California is up over 20%, right? And I think we all see that. If you own a home and you check the internet, right, and you go to the website looking at what is your estimate or Zestimate or whatever it might be, you're quite shocked over what somebody might be willing to pay. But the deals are out there. There's just not a lot of supply. There's a lot of demand, and that will make prices higher, something we're going to talk about more. But so up 20.3, it was up 11% in 2020. So we've seen a compounding almost 35-40% increase in real estate over the last 2 years. And California Association of Realtors is projecting another 5.2% in 2022.
Interesting.
Why is that? Why can these things go up so high? Well, money's really cheap. Interest rates are really low.
And we had a period during COVID where they couldn't build houses.
Right.
They didn't have the people to build them.
Right.
They didn't have the lumber supply, and prices shot up, and there are a lot of people that are sitting on huge gains in their homes the last couple of years. But what are you going to do? Sell it? What are you going to buy?
Right. Yeah, exactly. It's a great time to sell, but then where are you going to live? You have to go buy something else. So something that we're all looking at. But yeah, so we've seen a lot of inflation. Gas up, I think, over 40%. So that's something that usually gets stripped out of the CPI. So let's boil this back down to how it translates into people's portfolio and what we're looking at. You were mentioning something before the show to me. They're calling this last couple months the Great Resignation. And you've had just droves of people quitting their jobs over the last couple months that we've kind of really never seen before, looking for something bigger and better and brighter. And it's put pressure on a lot of employers, right? And so what are employers supposed to do?
Well, they've got to pay more to bring on new workers.
Right.
And you only do that in a good environment, a good employment environment. Unemployment is decreasing all the time. I think we talked about where do the most of the gains come from in employment. It's been from products, services, restaurants, hotels. That's still lagging. So we have a much smaller labor force available to fill those openings. And then the labor participation rate. Some people have made so much money and they've just taken themselves out, or they've decided they want to change their lifestyle. COVID's done some strange things out there. It's really made people kind of reflect and see what they want to do.
Yeah.
People working from home and working for a California company, moving out to Boise, Idaho, and living there. And it's a really interesting time. But employers are going to have a tough time bringing on new people without paying them more.
Yeah.
And
well, so let's talk about this, because when we're talking about inflation, I think the hot debate out there that people want to know is this temporary or transitory, or is this here to stay?
both. Don't you think?
I do. I think the debate is really what portion of it is temporary. And so the transitory portions are, look, we had COVID. It disrupted the global supply chain, right? We had a world where we were producing goods cheaper abroad, right? It's typically from Asia, China, and we were able to bring that in. And we've seen countries globally react differently to the COVID virus, and it's really disrupted our supply chain. And so we haven't been able to get the cheap goods here, right, to produce those products. And so we have lower supply and we have rising costs, right?
Right. And when you look at some of the products that you can't get all those cars sitting in the lots.
Mm-hmm.
They're brand new, and why aren't they moving? It's not demand. It's actually not even price for some of them. There are no chips. All these cars have chips in them, so we all know everybody's read about the global chip shortage. But those are definitely some transitory effects.
That's something that gets put back together.
It does at some point. I don't think the used car market is going to go up 20% a year.
No.
If you look at the Manheim Index, it's gone like this.
Yeah.
It's gone crazy, which is just pushing up the prices of new cars. And once some of these issues are in fact transitory, like chips, large durable goods, washing machines, fridges, there's just not a lot of supply out there. So the question I think a lot of people, or the conclusion a lot of people come to, is just that this is the reason that these products aren't available is because there's a shortage of them. And is it that, or is it there is increased demand, or is it a function of both? I think I pulled up a slide. I don't know if Sierra has that slide, but there's a slide from Bridgewater I thought was really interesting, because you just read about this global supply shortage, but they've got a chart here showing us that the actual demand is high, but it's much elevated from pre-COVID. And
So the demand for consumers to buy products, goods, services is higher than pre-COVID.
And actually the supply of those goods is actually higher than pre-COVID.
Right.
So
Wow.
I think I told you last night I was looking at golf clubs.
Yeah.
Everything I clicked on got to wait 6 to 8 weeks.
Right.
And so I think you immediately think, well, there's a shortage. And then you look at the data and say, well, maybe it's not a shortage. Maybe they've actually produced enough, but they've produced more than they did pre-pandemic, but they've misjudged demand.
So important question for you, Jeff. When you're out there looking for golf clubs, there's two types of people looking for golf clubs. So did you have a good day or a bad day on the course?
I had a bad day.
Okay.
It's the clubs.
So it's the clubs. I gotcha. So, I think you should go get the clubs when you have a good day, right?
Yeah.
That's when you can up your game. That's funny. So, sorry, take a little shot at you there. Yeah, it was the club's fault, right?
Yeah.
So 6 to 8 more weeks of bad golf, and then everything's going to be good.
Everything's going to be good.
Pars and birdies and
I can look at the other 3 sets sitting in my closet and wonder why I'm looking for the clubs.
yeah. Hopefully, the used golf club market starts surging like used cars. Well, so some of this is transitory. Some of it is here to stay because we do have this surging demand, and that is just because the American household consumer has a lot of cash after the stimulus, and that wages are increasing.
Right.
And I think you made an important part about what happens with wages. Can those be transitory?
That's pretty sticky. It's really hard to pay somebody a little bit more than you paid the last person, bring them on, and then when inflation subsides a little bit, go back to them and say, well, I'm going to pay you less. It's just not going to work.
Yeah, that just doesn't happen.
This doesn't happen. But if the component of whatever it is that you're selling costs you a lot more, because I think we met somebody the other day who ships in containers full of clothing,
Right.
and he's paying quadruple the amount
Yes.
just for the container.
Right.
And so what does he do? He has to pass that cost on, right?
Yeah.
But once we kind of balance this thing out, the economy is this one giant cruise ship. It's not a speedboat. You can't turn that thing around on a dime. It takes a long time
Yeah.
to get everything back in order. So when those prices come down, maybe he can bring his prices down. But in the meantime, he's got to pass that. So he passes on that cost to his retailer,
So,
and
but
they
that-
pass it on to us.
Right, but that's the transitory portion, right? Because sometimes a global supply chain gets back put together. And I think it's interesting, you make that distinction when you pay somebody more because there's inflation, right? Workers are motivated. They got their new salary. They're consuming more. They're going to immediately adjust their lifestyle, right? What do most Americans do if they get an extra $5,000? They're going to go spend an extra $6,000. So charge up that credit card, right? And then they're going to anticipate another raise, right? And so you're not going to be able to go back to your labor force and reduce those prices, or reduce reduce their incomes.
Right.
So that's going to be built in. And so that's really good for the consumer to know that they're making more money, and that is likely going to stay. But that is an increased cost that companies are going to have as they provide goods and services. Now, the balancing effect of that, however, is technology, because companies are going to have to trim other places in their balance sheet to deal with rising costs. And if you have labor costs increasing, which we haven't had a lot of that, what people will argue, over the last 20, 30 years relative to other inflationary measures. And so here you're having wages increase pretty significantly to meet demand, right? Just so there's enough people to produce the goods and services and feed the demand of the consumer. So this is all very, very good. The workers making more, which fuels more consumption, which fuels more productivity, and it's a kind of a nice cycle. However, you have these rising costs, and that could be inflationary, and we have this technological revolution we're living through. So as companies look to cut costs, technology could be that great, as we look over the next decade, the thing that's going to help us provide these goods and services at cheaper prices.
Right.
And so we're going to see some of our costs of these companies come down over time with technology while wages are going up. And I couldn't think of a better scenario for consumers, for American households, for the economy and the stock market, and just the standard of living, where the money that's being, made by the company is mostly going to the workers versus all the other costs that, they have to bear. So I don't know. I think that's a pretty encouraging sign if we see this. So keep watching this.
So question for you. The iPhone. Keep coming out with a new iPhone every year or two.
Yep.
More bells and whistles, more memory. The prices really aren't going up that much. Or the price of a TV or the price of a computer. Isn't that deflationary? Same price, you're getting a lot more output. You're getting a lot more bang for your buck. And you're right, as wages rise, and remember, the consumer's 2/3 of GDP.
Yep.
So I think you said it a while ago. It's like, well, if prices go down, they'll just buy more of stuff.
Exactly.
We had one TV in our house, now we've got 4.
Yeah, don't worry. They'll find other products for us to buy if the price is staying the same. We'll just buy 2.
Right.
All right, let's move on. So we're talking about inflation. So inflation is rising. Obviously, something's going to need to be done about that because it could get out of control, and that's been very bad for things like the stock market, housing market, fixed income across the board, right? If you have too much inflation, it could drive us into a recession, right? We know that historically has happened. So the Fed is here with their finger on some levers here, really trying to balance this. And so this could get a little heady. So let's just kind of talk about, interest rates and why, people like Jeff and I look at those, and other people who are watching Wall Street, why we look at interest rates when we think about the prices of assets like stocks, bonds, real estate, and how much they can matter. So first, let's just think of what interest rates are. There's good debt and bad debt, right? So the bad debt is the credit cards. It's, I want to buy something, I don't have any money, so I'm going to rob from my future self, I'm going to charge it, and then when I make money in the future, I'm going to have to pay that back. And that could be a pretty vicious cycle. It costs, 25% in interest. You're losing lots of money when you do that kind of purchasing. Good debt, of course, is when you borrow money to acquire assets that produce income in the future, right? So whether that's companies, real estate, education, whatever it is, I'm going to borrow some money so that I will have more income production in the future. So long as that income is sufficient to pay the principal plus the interest and then eke out a profit, that's a very good thing for households, economies, governments, corporations to do. So what the government is doing, as we have a lot of debt and we have created a lot of stimulus, there's 2 kind of levers that they have to control interest rates. So one is that printing press, and we are doing a bond purchase program, and you're going to hear a lot of this talk about the Fed and tapering, but essentially we're printing still, I think it's still $120 billion a month, right? Where the Fed is buying bonds. Essentially, I'm going to take these IOUs and I am going to just put cash, $120 billion. So that's essentially a printing press, and we're just printing more money. And there's already a lot of money in the system, right? And we're continuing to print money, which is going to keep driving inflation. And then there's also the federal funds rate, which is what the rate is when they say, is Powell or is the Fed going to increase interest rates? This is the rate in which banks lend each other money overnight, which has been at or near zero for a decade. Historic, unprecedented time that we've ever seen that. And what that does is it makes money really liquid and fluid, and it flows very easily throughout our system, right? And so we've had those very favorable monetary policies going on, and we start to have inflation. So now we're getting ready for, what's going to happen when we have this undoubtable change in that favorable policy, because if they don't change it, inflation could get pretty unruly.
Right.
So step 1 is what? Tapering?
Tapering. So they're taking down $120 billion a month. They're taking it down 10 or 15 billion a month until they get to zero and see how the economy's doing. And at that point, then they're ready to kind of start their trajectory of increasing interest rates.
Right. So I'm gonna put a halt on the printing press. I kind of think of there's this geyser, right? They can control the spigot that's controlling this flow, right? And there's just money flowing, and they got a couple ways to slow it down. And one is I can stop, one of these. I could turn off one of these pipes and stop flowing that money into the economy. Right, and that kind of makes sense. That's an easy thing to do. When that happens, undoubtedly, there's going to be some turmoil temporarily in the markets, but it should be a good thing overall for inflation.
Yes.
The next thing is, do we start to tighten monetary policy by raising interest rates? Right, and this is going to, in effect, start taking money out of the system. I mean, do you remember a time when banks used to pay interest?
I actually do. I do.
You might.
I'm showing my age.
I have to read about it. But yeah, I know. I didn't have a lot of money when banks were paying interest. But oh my gosh, it has. There was a time when you used to have your money in the bank and you would actually earn some rate of return for sitting on cash. And so right now, we don't have that. We haven't had that in a long time. So we've been incentivized to invest our money. If you're sitting in cash, you lost 6% over the last year. Literally lost 6% of your purchasing power of those dollars. So we're incentivized to buy things, acquire assets, stocks, bonds, real estate, cryptocurrency, etc. Because if I sit here and lose 6%, that's a losing proposition.
Right.
Essentially, almost anything is better than that. And this is where we're going to start talking about risky business, because this is what's really fueled a lot of purchases and which is creating prices to go higher, right? What happens when I get compensated for doing nothing? And it hasn't been like that in a long time.
No.
But you might think twice before you take that money out, lose that interest rate, and go buy something for a promise of money in the future versus a guarantee of money today. And so that's why interest rates really matter, and there's different sensitivity that we have. So let's talk about risky business and how this interest rate, once the Fed starts doing their tightening policies to curb inflation, what does this mean for our assets? I mean, because if you're looking to invest today, you want to go and acquire something, you want to go buy something, what looks good? What looks like you're getting a good deal? Certainly not used cars. We've talked about that.
No. Everything's expensive.
It's all expensive.
Yeah.
Stocks.
Bonds. Real estate.
Oh my gosh, yeah. Go in the real estate market.
Golf clubs.
Apparently golf clubs, right? Crypto. I mean, everything, the prices have surged. So then what? What do? Oh, I'm not going to buy. I'm going to sit in cash. I'm going to lose 6%. So here's the kind of the world that we're living in and what happens to interest rates. And this is really important for folks to get prepared for the future and make sure that their portfolios are well allocated, because we can kind of do the math to figure out what are some things that might happen. And so for you to be aware of that as you go through this next investment cycle. And I tell people right now, make no mistake, this is the good time. There's nothing wrong with enjoying the good times. Labor markets are looking good. There's lots of liquidity in the system. Households are very strong. Credit card debt is lower than average. Incomes are rising. Asset prices are higher. Interest rates are low. I mean, hey, let's do a dance. Let's celebrate. That's pretty good. But we've all been around long enough to know that things just don't go up forever. And sometimes there might be some hard times ahead. If any of us needed a reminder of that, we got that in 2020, of course, with COVID. But so what do we do? What are the impacts of rising interest rates, for instance, on our bond portfolio?
Well, I think everybody knows that when it comes to bonds, as interest rates rise, bonds have to go down in value, right?
Yeah, unfortunately, not everybody knows that. They should. It should be a course in like 5th grade, I think. But
right.
So yes, you're right. So explain that.
So if you have a bond and you paid $1,000 for a bond and it's paying you 3%.
Okay.
And so you're getting a coupon of $30, $15 every 6 months.
Okay.
And then all of a sudden interest rates go up, and now they're offering a bond with 4%.
Right.
Nobody's going to buy your bond for $1,000.
No.
They're going to pay you a discount.
Right. Because
your bond has to basically move to be equal to that 4% bond.
Yep.
So the yields become the same.
Right.
But the principal's gone lower.
Yes.
So
so interest rates go up, our bond prices fall, right? And that's how you kind of meet the market.
Right.
Okay. So then, all right, what about stocks? So then if interest rates are coming up, I'm looking at bonds, and they're sensitive to interest rates. So are stocks less sensitive?
They're more sensitive.
More.
Well, they can't be.
Okay.
Because as interest rates go up, it makes the hurdle rate for a stock higher, meaning these growth companies that everybody knows about. If you look at the NASDAQ 100 and you look at the S&P 500, you look at the top 10, a lot of those are technology companies. What are they doing? They're growing. And they're growing quickly. So they're growing. Every year, earnings are going higher and higher and higher. Well, all the analysts out there, they do what's called a discounted cash flow. What's the present value of that stream of cash flows that we think they're going to earn over time?
Right.
And they discount it by a nice little formula. And in there is interest rates.
Right.
Well, if you move interest rates higher, your discount rate goes higher, so your present value goes lower.
Right.
So if you can basically get hit both ways.
Right, and that's kind of going back to the demand, right, of what we're saying. So what are consumers going to make if they just did nothing, right? And so they would expect there's going to be a higher premium that they're going to want on those future cash flows, meaning they will pay less to get that premium, which means the price of stocks are falling.
Yep.
Okay. So that sounds pretty difficult.
We've got two things falling with interest rates.
So, and I think that this is really important, and then why we as asset managers look at the curve of interest rates, and we want to see where those rising costs in interest rates are and how that's going to affect things in our portfolios. And we also know this about assets like that you own, like companies or real estate, is that over time they go up permanently and they go down temporarily. And this is where your asset allocation is so important. It is the number one criteria that you need to fix for your financial plan, is figure out where your money's invested and what's going to happen in the future when these things undoubtedly do occur. We don't know when, but we know that inflation, taxes, market crashes are the three biggest threats facing us, and we have to have a plan to address them. But so, yeah, if we think about that, we're thinking, okay, there's inflation. Let's just do a hypothetical scenario, right? And there's 1,000 of them out there that we have to be prepared for or more. But let's say we have this hypothetical scenario. We have rising inflation, okay? Well, that could spur us into a recession. So we're going to have the Fed increasing the short-term part of the curve, right? And so now this is going to start to put pressure on stocks. Their costs are going up, and then also and bonds are going down as well, right? So rising interest rates, so the demand for bonds are less, so the price is going down on our bond portfolio, and then over time that starts to impact our stocks. And if we get concerned about that and the stocks fall, then what happens?
Then people sell stocks and they go buy bonds.
And when people buy bonds, what does that do to the interest rate?
Well, it drives the yields down and the bond prices go up.
Right. And so you have this nice balance, right? And so we don't have to be worried about inflation, taxes, market crashes. We know that those things are going to exist. And so if we have that balanced in our portfolio, you're saying, okay, interest rates started to rise, my bonds might not start looking so good in the short term as stocks continue to rise. And then at some point those stocks fall potentially with those interest rate moves. And then what do people do? They're flying into bonds. And what does the government do with interest rates in a falling stock market?
They start reducing
They lower
rates.
them, right?
What does
and
that
start
do to
creating
your
more liquidity. And then your stocks start to buoy and come up again. So this is the balance that we have over time. And so you have to be able to invest in things like equities, stocks, real estate, crypto. You have to be able to hold through a market cycle, or better yet, multiple market cycles, because it's really hard to predict this stuff, unless I'd like to say it's impossible, right? So we know that there's going to be these events that occur in the future. We don't know when, but we could do the math to get prepared for them. And I know we're running up on time, but I just wanted to share this statistic that I read a couple months ago. This was a study done, or a survey done, of American households in September of this year. And they found that out of the American households that were investing in the stock market, over 70% of them said that they would sell their stock portfolios if the stock market was to experience a moderate to severe decline. And what does that tell us about 70% of American households invested in the stock market?
They shouldn't be in the stock market.
They shouldn't be in the stock market, right? If one of our genetic defects of our financial DNA is undoubtedly we love to buy things high and sell them low. And so let's not have that strategy. Let's not be that 70%. Hopefully the people tuning into this show are that other 30%, or some of that 70% that's getting converted. But we know that the stock market's going to experience severe to moderate declines. Actually, pretty regularly, much more frequently than we'd like to admit. But this is a really important time. These are the good times to look at your asset allocation. And Jeff, you and I talk to hundreds of people throughout the year. You're making decisions on $300 million of assets and placing capital for our clients. I'm sitting down with individuals and I'm looking at their balance sheets, hundreds of people throughout a year, and I can see where everybody's invested. And there's a wide range, right? This spectrum is a wide range. And the two kind of problems that I keep seeing are, one, those that are sitting on the sidelines, right, waiting for a better time. Please don't do this. That it is a strategy that almost never works. If this is your strategy, get a new strategy. And if you had this strategy before, then you went all in March of 2020, so you're already done. If you didn't go all in, then you know the strategy doesn't work for you because you had the exact thing you were waiting for and you didn't do it. So we got to be in. But our asset allocation says that not all of our eggs are in one basket. And so we can have winning scenarios in our portfolio in just about every market environment if we can properly allocate our capital. Now, The other side of the spectrum, they've been lulled to sleep over the last 10 years. They're not really sure what they're investing in. They know they have some funds or tickers or companies, and they know that their money has done very well. And let's say they are all in on the stock market, right, or all in on risk assets. And they've seen a dramatic increase. In many cases, I'm reviewing these people's portfolios, and they've doubled over the last 5 years. Ladies and gentlemen, we've been around long enough. We know that sooner enough we reach an apex. And if you are one of these people, just have a strategy or solution to not just sell low when the market's going down. Okay, so this is the good time. This is the time to review your portfolio, make sure you're properly allocated. We do have some headwinds right now with inflation that are real, and they are killing the value of your money. So if you look at your portfolio return, back out 6%. That's your real rate of return over the last year.
Right.
Okay, that's important to know, right? And so when we're looking at that and we're looking at, okay, there's some potential changes on the horizon, how is my portfolio going to fare? And we can do that stress test. We can analyze that, and that's what we're here to do. Any parting words?
No, I think that about covers it.
Yeah.
I mean, we got a lot done in half an hour. I mean, we could have gone on for hours on this.
Yeah.
Probably would have bored people, but I think that was good.
So I think coming to our next show, one of the things that we didn't talk about, and there's been a lot of conversations, are about taxes. And of course, we're only going to pack so much in these shows so that you can get on with your day. But tax legislation and future potential to taxes are definitely going to be part of our next show. I know that's top of your mind. And right now is the time to be getting our tax strategies done. We're not waiting until after December 31st or filing our taxes in April. We want to start working on those now. You essentially know what your income is, you know what your deductions are, and you still have the ability to change things before the end of the year. So we're talking about tax planning, more investment cycles, and investing news on our next show. Thank you guys for joining us. Jeff, good to be with you.
You too. Thanks for having me.
All right, we'll see you next time.
Bye-bye.